let's go ahead and begin. Good morning. This is Mahesh Odrani with Strategic Wealth Design. It is my pleasure to welcome you to our crucial tax planning decisions for year-end for 2020 and looking beyond. A couple of housekeeping items as we begin this webinar. Everyone is on mute currently, so we cannot hear you, and we don't have background noise. There is the handout in the handout section of the GoToWebinar app that's on your computer. You should be able to see the handout. You can see a copy of the presentation and the slides if you'd like to take some notes, so feel free to download that and print that out. Also, at the tail end of the presentation, there will be a survey that will pop up as well, and you'll receive that survey via email also. So I would highly I would request and that you do complete that survey, because we do take feedback seriously and really help us improve upon these events and these webinars. And another item, which is the question box. So there's a chat in the question box. As we go along, I'm sure there's going to be questions that you have popping up in your mind and you'd like to ask our presenter. So what I would suggest is go ahead and put those questions in the question box, and I will pause when the time is right. We'll take questions at the tail end as well, but if the time is right, I will ask those questions of Dean, our guest speaker today. So go ahead and put those questions in the question box or even the chat box, and I'll make sure to cover those. So Dean, would you mind going to the next slide? And then lastly, just want to say that this presentation is more general public use. It's not designed to give you specific advice in your situation. If you'd like specific advice, please do give us a call, and then we can discuss your specific situation. So with that said, let me introduce our guest speaker today, Dean. Dean Mioli. He is the Director of Investment Planning with SEI, and he has been with SEI. We were chatting a little earlier. He's coming up to 15 years with SEI. So, and in his role, he's responsible for supporting the delivery of advice-driven asset management solutions for SEI's advisors and their clients. His team provides income tax minimization strategies, as well as advanced financial planning support to advisors like myself and our team here at Strategic Wealth Design. Dean has been quoted in publications such as Barron's and Financial Advisor magazine, and has published articles including the Philadelphia Estate Planning Council newsletter. Prior to joining SEI, Dean was a client relationship manager for CIMa Companies, a private equity and private real estate firm located in Philadelphia. Dean was previously a financial planning technical manager at the American Institute of CPAs, and spent several years in personal financial planning practice and tax technology group with KPMG. Dean graduated from UCIMa College with Bachelor of Arts in Economics and Business Administration with minor in accounting. He holds the FINRA Series 7 and 63 licenses, and in 2004, 6, 2009, and 2012, Dean also served as an examination content specialist for the Certified Financial Planning Board of Standards. And Dean, I believe I took my CFP board exam in 2012 or 13, so I probably came across your content when you did that. So probably. Dean, with that, it's a pleasure to have you be a guest speaker for our event today, and the floor is all yours, so go for it.
Thank you, Mahesh, and good morning, everyone out in the greater western part of the country. Of course, I'm back here east, and tonight I have to make a decision whether to watch my Eagles, who are playing terrible, versus the New York Giants, who are also playing terrible, or watching the debate. So we'll see what I decide on. All right, so let's get going with our presentation. Here's our agenda. We're going to get into some income tax planning. Of course, this is part of the year where we kind of want to review where we stand with capital gains and losses. What have we realized this year if we're in a net loss or a net gain situation, and then what play do we want to call before year end? Roth conversions, #1 planning idea for 2020 is the Roth conversion. We'll get into that. Of course, there are no RMDs for this year, but as it stands right now, RMDs are set to return for 2021. We're going to go over basic estate planning. COVID has really made us all take a personal look at all our documents to make sure they're up to date. And we are in an environment where there is very heightened political and tax risk, and we're going to cover that as well. First thing that I want to cover are the tax rates for 2020. And one thing that you can do is manage your tax bracket. it's really important to understand what tax bracket you're in, how close are you to the bracket below you and the bracket above you. And we have 7 tax brackets now ranging from 10 to 37%. Historically speaking, we are in a very low tax environment, though depending on how this election goes, this could change overnight, sometime next year, maybe the year after. It's certainly scheduled to change at the end of 2025 because we will revert back to higher tax rates at that point. But let's take note of something here. And if you're filing married filing joint, which is the middle column, you are still in the 24% bracket up to $326,600 of income. That covers quite a few Americans. And there's a lot of great tax planning you should be doing as a married couple. If you happen to be single and you have that same level of income, 326, guess what? You're in the 35% bracket. So it's important to understand what bracket you're in. And in many cases, if you're paying tax at 10, 12, 22, and even 24%, I think that's an extremely reasonable rate. Once you get above that, 32, 35, 37, we're certainly looking into minimizing income at those levels if possible, accelerating deductions at those tax rates if possible. So again, important to know, get your taxable income off of your tax return from last year, see what bracket you're in, and then of course where you are relative to the 2 brackets that are surrounding you. So let's talk about this. So when it comes to capital gains and losses, believe it or not, it can be very advantageous to harvest gains if you're in the right tax bracket. And if you happen to be in the 10 or 12% federal bracket, which is up to about 40,000 of income for single filers or 80,000 for filing joint, you have a 0 long-term capital gain tax rate. And that also applies to qualifying dividends as well. So for instance, let's say you are a married couple and you have projected taxable income of 50,000 this year. Well, you could harvest 29,000 on long gains. Now your total income is still below 79,999. Guess what? Those 29,000 of long gains you just harvested would be taxed at a 0 rate. Now, once you break through this number, even including your capital gains, of course, you'll start paying tax on capital gains. So as a general rule, 10 or 12% bracket, if you're looking for cash flow, which would not be taxed at the federal level, consider portfolio gain harvesting. Now, some of you who are listening may have had suffered economically from the COVID situation and you're looking for cash flow. Well, this is one way to get it and not pay tax. Okay, so take note of where you stand with realized gains and losses. Okay, anticipate what you might think is going to happen by year end. If you're invested in mutual funds, take into account the capital gain distributions. We have started to announce SEI our capital gain distributions out of our mutual funds. And keep something in mind. If you're in a higher bracket than 12%, we certainly want to do tax loss harvesting, but losses are limited on how much you can take in a given year. So you're allowed to marry your losses to your gains and wipe out all your gains, and then you're allowed an additional 3,000 of losses in excess of your gains. Now that might be hard to come by because we have a pretty strong market this year after March. And you may not have losses in your portfolio, but if you do, and you're in a gain situation greater than 12% tax bracket, you should be looking to harvest losses. Now, again, as I mentioned, you can take 3,000 of losses in excess of your gains. If you happen to realize more losses than you can use, you don't lose them. They get carried forward indefinitely and can be used in future years. So something to keep in mind. I wouldn't be overzealous with my loss harvesting, but I certainly want to be in a position where if I could wipe out my gains, I would do so in a higher tax bracket. Now, as I mentioned, question.
May I ask you a question about the capital gains, if you don't mind going back to the previous slide? So with capital gain loss harvesting, the premise around that is basically you sell some investments at a loss to capture those losses. So you can create that magic number that you talked about, the $3,000 of losses. and offsetting that against the gains. But we as advisors always talk about, hey, we cannot time the market, right? So we cannot time what the market's going to do. With tax loss harvesting, how do you ensure that if I'm selling an investment at let's say at a loss, but still maybe a good value going forward, like how do you ensure that investments are not out of the market?
Sure, good question. Now, in our tax loss harvesting exercise, whether you're using our mutual funds or ETF program or individual managers, if let's say we own Pepsi in our portfolio and we decide to loss harvest in Pepsi, well, there is some rules around taking a loss and then reestablishing the same position. So if you're going to sell Pepsi for a loss, you can't go buy Pepsi back within a 60-day window, otherwise you can't take the loss. But guess what we can do? We can buy Coke. So this way we take our loss, we get to use it, and then we buy not the same stock, but a similar stock where we represent that same sector of the market that we want to be in, but we just put it on a different horse. Now, after those 30 days are up, the manager can switch back and sell Coke and buy Pepsi back if they want to. But we stay in the market. It's just a matter of changing horses temporarily so we can book that loss and take that loss. Does that answer your question?
Yes, it does. And but to clarify, I think you threw out two numbers. So you said 60 days and 30 days. What is that the timeline of the stock? Once you sell it, you can buy it back again. Is it 30 days? It's 30 days, correct?
Yeah. So there's if you sell Pepsi at a loss, there's 30 days before and 30 days after that it's really a 60-day window that you can't buy that stock back. So in my second example there, if I had sold Pepsi for a loss and I couldn't buy that stock back for 30 days, but really the window is 60 days, 30 days before I take that loss and 30 days after I take that loss.
Got it.
Does that clarify that?
Yes, thank you, Dean.
Okay. But what we try to do at SEI is we strategically use volatility to do tax loss harvesting. Now, earlier this year when the market was in a tailspin in February and March, we did some heavy tax loss harvesting because that's what the market presented to us. Those losses have economic value. And then later this year, as the market came back, storming back, our managers were realizing gains. And of course, those losses were there to mitigate those gains. And we still have some in our back pocket as well. Now, as I mentioned earlier, I think the number one idea this year is the Roth conversion. And anyone with a traditional IRA can do a Roth conversion. And you can do as much as you want. There is no limitation on how much you do. There's no limitations of any kind. And to me, it's really a no-brainer if you're in the 10, 12, 22, or 24% bracket. And again, best to do this when you're married if you can, as opposed to being single, especially if you have are in some type of retirement where maybe your income is way down temporarily. Maybe you're going to part-time work, maybe you're not working anymore at all, living off of your portfolio. Great times to be doing Roth conversions before you start taking what we call required minimum distributions, which is now at age 72. Again, important to look at your tax bracket and understand where you are. And then, for instance, let's say I'm married and have taxable income of $150,000 this year, I'm projecting. Well, I could harvest 20,000, or excuse me, do a Roth conversion for 20,000. I'm still in the 22% bracket. So that might be the upper amount I might want to do in a given year. Roth conversions don't have to be all done in 1 year. It could be done over a period of years, systematically to do these. And there's several benefits to doing a Roth conversion. The biggest benefit is if you're in belief that tax rates are going up, and this is the most critical point of this whole exercise. If you believe tax rates are going up, getting the tax man out of the way now makes all the sense in the world. And that's essentially what a Roth conversion does, because you will pay tax on converting your pre-tax money, which is typically what's in an IRA, to after-tax money, which is what a Roth account is. And there's lots of benefits to Roths. One is, of course, when you take money out of a Roth later in life, it comes out tax-free. When your kids or grandkids inherit a Roth, they again will get that money tax-free. I like the sound of those two words together, tax-free. Very powerful. I get a very warm and fuzzy feeling when I hear those words together. Between spouses, let's say I pass on, my wife could take my Roth and make it hers. Okay, spouses can do that. They can roll over a deceased spouse's IRA, again, for more tax-free growth. There are no required minimum distributions for Roth accounts if you're the original owner or my spouse takes it over, okay? No RMDs. With a traditional IRA, yes, you're on the hook for taking required minimum distributions, putting this year aside. And there are ways to make a Roth conversion, basically tax-free conversions. And there's different things you can pair with a Roth conversion to make them a very low tax cost exercise. One way would be to increase your charitable contributions. Of course, charitable contributions is a deduction you could take on Schedule A of your tax return. This year, as part of the CARES Act, they have a thing called the Qualified Charitable Contribution, which if you give cash directly to a charity, whether it be a church, synagogue, United Way, Red Cross, etc., you can take basically 100% write-off of that charitable contribution. So if you happen to do a $40,000 Roth conversion and decide to give $40,000 to charity at the same time, the charitable deduction will wipe out the Roth conversion income. Essentially, you won't have any tax bill on that Roth conversion. Now, of course, you don't have to do 40,000, you can do 20,000. Point being is pairing tax strategies like this can really set you up for a tax savings powerhouse. Again, some of you may have some issues with the COVID and had some economic effects to that. Maybe your businesses are down with revenue, income. Again, may have generated a net operating loss. Use that net operating loss. Let's turn lemons into lemonade. Do a Roth conversion while you have those losses, okay? And if you're thinking a little bit in the future, when you take Roth distributions, it does not impact taxation of your Social Security benefits, which is nice, and it does not have any effect on the determination of your Medicare premiums, okay? Now, in a year of a Roth conversion, of course, those two things would be impacted by that, but not going forward, which is really, really important. And this is 1 year I would normally not recommend withdrawing dollars out of an IRA to pay for a Roth conversion and say, well, I don't know if I have the money to pay for a Roth conversion. If you're over 59.5 and you take money out of your IRA, of course, there's no 10% penalty. So if you're under 59.5, I don't know if I would take money out and incur a penalty to do a Roth conversion. But this year, given the high likelihood of taxes being raised, this is 1 year where I would actually pull money out of my IRA to fund a Roth conversion, not mean withdraw those tax dollars to pay the Roth conversion. But like I said, there are other ways to pay for that Roth conversion. So it's a good time to talk to your CPA and get Mahesh involved and see how you can get that done at the least possible tax consequence.
Yeah, and Dean, just a quick comment. Because the RMD, the 10% penalty is waived up to $100,000 till December 31st, correct?
Well, yes, if you, a Corona-related distribution is what Mahesh is referring to, which you're allowed to do up till December 30th, and it can be up to $100,000. So yes, if you, you can self-certify that regardless of age, that means you don't have to be 59.5. You could take money out of your IRA and actually spread the tax bill over 3 years, and you could use those dollars to pay for your Roth conversion. So yes, that's a great idea, Mahesh. And this way you can get money out pre-59.5 without the 10% penalty. And no tax withholding either.
Yeah. So that's a great strategy. A lot of people are thinking about, if you have been impacted by COVID, is to think about the that you can pull out funds out of your IRA up to $100,000 without tax withholdings and without the 10% penalty, and that's key. And still be able to do the Roth conversion without the 10% penalty. But the key is that tax consequences also spread out over 3 years. So it really would help you minimize the tax consequence, or spread that tax payment out over 3 years. Now, if I'm not mistaken, Dean, that if I spread that tax consequence over the 3 years and taxes go up higher, let's say in the second or third year, I may be subject to higher taxes on that distribution, correct? If the taxes have gone higher, it's not based upon my tax rate as of 2020.
Yeah, there's a potential for that, absolutely. But let's say you took out $30,000 to pay for the Roth conversion cost. So you would pick up 10,000 of income this year, 10,000 in 2021, and then another 10,000 in 2022. So if we're talking those kind of numbers, I don't know if 10,000 is really going to move the tax needle all that much.
Yep.
Of course, if you had to pick up significantly higher amounts, it could very well be the case, but something to run a tax projection on to see if it would bump you up in a higher tax bracket. But in an example I just gave, you had to pick up another $10,000 a year. I don't think that would really affect your tax situation hardly at all.
Sure. Thanks, Dean.
It's always good to run the numbers, though. Just a little update here regarding requirement minimum distributions. Of course, everyone got their RMDs waived for 2020. And reading the tea leaves now, we do expect RMDs to return in 21. And for those who are taking RMDs, the required minimum distribution amount will go down a little bit. And of course, we do have a new RMD age of 72, though, and I'll talk about this a little later, there is a tax planning idea called the qualified charitable distribution, which is great for people over 70.5, and you only have to be 70.5 to do this, where you can give some or all or even more of your RMD directly to charity. And there's some really good tax benefits to that, and we'll talk more about that in a bit. Though I will mention that we're on the RMD page to say that, again, looking at your tax brackets, let's say I happen to be in a low bracket, 10, 12, maybe 22%. And of course, I didn't have to take my RMD this year. Well, I'll give you two ideas. One is, since you didn't take your RMD, and let's say your RMD was 25,000, well, if you didn't take your RMD, then do a $25,000 Roth conversion. You're in no worse condition than if there was an RMD. Okay, you would pay the same amount of tax, but now you have 25,000 in a Roth, which can grow tax-free forever. Okay, and your future RMDs will be less because your traditional IRA balances are down. That's one idea. The second idea would be, well, maybe you still want to take a distribution from your IRA, even though it's not required, because if I can get it taxed at a low rate, that's not a bad thing to have happen. Okay, I don't mind paying tax as long as I pay it at a rate that I think is very attractive. I just don't like paying tax at high rates. So you might want to consider taking money out of your IRA before year end. Of course, you'll be taxable, but if it's at a low tax rate, so what? That's not such a bad thing. So when you look at the distributions, if we had RMDs this year, these are the payout rates based on your age. Okay, so let's focus at age 75. You notice it's 4.37. Next year, it'll be 4.07. So the RMDs will be a little bit smaller, not life-changing, but I just wanted to give you a heads up on that. All right, let's get into some itemized deduction planning. Now, most Americans, believe it or not, do not itemize. The last IRS statistics I saw, over 90% of Americans no longer itemize because there were significant changes back in 2017 that really limited people itemizing. So most people don't take a medical expense anymore. Most people have insurance and Medicare, and you do have to hurdle 7.5% of your AGI, your adjusted gross income. So if your AGI is 100,000, which is AGI comes before your taxable income, you'd have to have out-of-pocket expenses greater than $7,500. So in excess of what insurance is covered. A lot of people don't have those situations. State and local tax is limited to 10 grand per year now. So even though you might have real estate and income taxes 30,000, the most you can deduct is 10. You may or may not have a mortgage, right? And the only other deduction around is charitable. And that really is now the fulcrum of whether you're going to itemize or not. So normally, when you give cash, you're allowed to take, if you give $100,000 in cash, you may not be able to deduct all of that. It depends on who you gave it to. If you give it to, for instance, a donor advised fund, it gets limited to 60% of your AGI. So the most you could take in a given year is 60%. And whatever you can't deduct this year, there's a 5-year carry forward. But as I mentioned, for this year and this year only, if you give cash directly to a charity, whether it be your local church, synagogue, United Way, etc., you can get the 100% write-off. That's why I like pairing that with the Roth conversion. Now, what I also would like to mention, and the service that we provide, we do a lot of tax return reviews, and we're looking at how we can improve people's tax situation. A lot of people give cash, which is great, but something to consider better than cash is appreciated securities. And the reason why is this: even though the limitation is less for appreciated securities, it's 30% of your AGI as opposed to 60% normally, is if you had to sell the security to write the check, well, guess what? If you sell the security at a gain, now you got a tax bill on that gain. But if you just give the security directly to the charity, which they'll be glad to take, you get out of the gain, plus you get the charitable deduction. So let's say you bought Peloton earlier this year at $25 a share, and now it's at $130 a share. And you say, well, that's a huge move. Peloton's done. I'm going to cash out of Peloton, and you got a $10,000 gain. So why not just give your position in Peloton to charity? You don't have to pay tax. The gain on the highest tax bracket, if you were to sell the Peloton, is $2,380 federal. Give it away, okay? And that would be at a long-term capital gain rate. If it was a short-term capital gain, the tax rate could almost be double that. All right, so a huge tax bill. If you just give the Peloton stock away, you don't get any tax bill, but you still get the charitable deduction. Okay, something to be cognizant of. It's nice that you want to give to charity. Generally speaking, appreciate securities better than cash, though I will caveat it for this year. If you're looking to do Roth conversions, it might be best to give cash directly to the charity so you can get that 100% offset on the Roth conversion. But that little planning idea is only good for this year. And we're going to talk about donor advised fund a little bit more now coming up, because we've seen a huge resurgence in the use of a donor advised fund, which is basically a charitable vessel for you and your family to use for multiple generations. And we'll talk about that in a second. So what is a donor advised fund? Shameless plug coming, SEI has one. It's called the SEI Giving Fund, but we're not the ones out there that have it. There's several other companies that provide these as well. There's well over $100 billion of assets in donor advised funds. It's a very popular vehicle. Our vehicle only has a small minimum of $10,000 you can start one with. And really what the whole point of this is you can donate assets today for charity, get a tax deduction now, and then decide later on what charities are going to benefit from this. So you can put in cash, you can put in marketable securities, you can put real estate in, Bitcoin, all kinds of things can go on this donor advised fund. And what's going to happen is our partner in this is called REN PSG. They're going to go and sell those things. And then you have to invest in one of our portfolio models that Mahesh can review with you. Once the assets are in there and put in an appropriate model, those assets will grow tax-free, okay? This is a great way to centralize and organize your charitable planning. If you want to give anonymously, you can. It's a much less expensive option and much easier to operate than, let's say, doing a private foundation, which certainly might have some sizzle, but I wouldn't even consider doing a foundation unless we're getting into 7 figures, okay? It's just not worth the hassle of filing tax returns and having board meetings, and then of course there could be some taxation of your earnings inside a private foundation. It can be a real pain, but if the dollars are right, it can make sense. But for the 98% of us out there, the donor advised fund is definitely the way to go. It works very simply, okay? The donor will contribute property or cash to the donor advised fund now and receive a tax deduction. Later, whenever they decide, and you don't even have to do it every year, you can make grants from the donor advised fund to your favorite charities. And in the meantime, when the money's inside there, it will grow tax-free, okay? None of it can come back to you. It's a one-way street, so you gave a gift, it's irrevocable. But what you can do is not only you can be a director on where those grants go, but your son, your daughter, your grandkids, whoever you want could be directors now or in the future. So you could establish one of these, and this could be a legacy asset for years and years with your family. And there's a really popular strategy that we can do with the donor advised fund, which we will get into. So some of the ideas here is, of course, if you donate appreciated securities, the tax gain is not recognized. If you have a high income year this year where maybe you panicked earlier in the year and you sold out of your portfolio and you realized a lot of capital gains and now you got this big tax bill. Well, do you want to pay big taxes? Maybe not. Maybe you had a stock option exercise or a big bonus. Maybe you sold real estate or a business and your natural tax rate is gone and you're in the top tax bracket. Well, this is the year to accelerate deductions into a high income tax year, right? This is when it's going to pay you the most to give to charity. But you say, Dean, I normally give, like $6,000 to $7,000 a year to charity. And even though I had a big income item this year, I don't know if I want to turn over like $30,000 or $40,000 to charity in one year. I get that. How do you do that though? Well, if you use the donor advised fund and you put in the appreciated securities or you donate cash, it just goes in the donor advised fund. It didn't give it to any charity just yet. Once it's in the donor advised fund, you can still peel out of that donor advised fund on your regular charitable schedule. If you'd like to give $7,000 a year, do it. You don't have to pay out $40,000 in one year out of the donor advised fund. You could put $40,000 in so you can maximize your charitable deduction against high income, but you don't necessarily have to pay it out that fast, okay? And again, pairing the donor advised fund with a Roth conversion can make a lot of sense. And I believe I have, I want to talk about this lump and clump strategy a little bit here. And what I'm referring to here is you should take a look at your tax return for 2019 and see if you itemized or not. Maybe most of you already know whether you itemized or not. Again, if you totaled up your medical expense, your state and local tax, your mortgage interest, your charitable contributions, where did you stand? This year, as a married couple, you itemize once you get over $24,800. Why $24,800, Dean? That sounds like a weird number. Well, that's the standard deduction. And that's what the government gives you right out of the gate. You don't have to prove dime one. You file jointly, you get a standard deduction of $24,800. If you file single, you get half that, $12,400. To itemize, you got to exceed one of those numbers depending on your filing status. So let's say you came up short. Let's say your itemized deduction schedule came out to $22,000, and that's what you're projecting for this year. Well, to itemize, you need $24,800. So what do? Well, normally you give, let's say, $3,000 a year to charity. Well, maybe you accelerate that. Instead of giving $3,000 this year to charity, you give $10,000 or $11,000 or $12,000, okay? Now you're clearly going to itemize because you just blasted through the standard deduction. But like you say, I don't necessarily want to turn over $12,000 to charity this year. Well, put the $12,000 into the donor advised fund. You get the deduction now, and you can make the charitable contributions later. We call that the lump and clump. Lump your charitable deductions all in 1 year, clump them into the donor advised fund. It's a really tax smart idea. Now, I will talk about the qualified charitable distribution. For those of you who are over 70 and a half and charitably inclined and are struggling to itemize, which many retirees are because they're normally not working, so there's no income taxes, state income taxes that they're paying. They may not have a mortgage anymore. That's a good thing to have when you're retired, no more mortgage. So, but they have a good portfolio, and they might not need their required minimum distribution to maintain their lifestyle, but they have to take it because the government forces you to take it. That's why it's called required minimum distribution. So what can I do? Well, you can actually give some of your RMD directly to charity. Maybe a lot more than that. It's up to $100,000 per person can come out of your IRA and give to charity. Now, if you do that, give your RMD to charity, you get a huge tax benefit. Now, you won't get a charitable deduction, but that's okay. You get something better, because when you give your RMD to charity, you will not have to pick up what you gave to charity as taxable income. It actually reduces your adjusted gross income and it reduces your taxable income. And by doing so, that will help you all over your tax return. Reducing AGI, adjusted gross income, extremely important concept, very important to do. And that's why this qualified charitable distribution is so powerful. Now, this year you may have done it or may not have done it. If I was your advisor, I would probably say, no, let's not do it this year. Let's double up and do it twice as much next year. So if you're thinking about doing this for 2021 tax year, come January, that's when I would do it, because it's important to know that the first money out of an IRA is your RMD. If you're going to give your RMD to charity, do it right out of the gate. Okay. And again, whatever you turn over, let's say your RMD for next year is $15,000. If you gave 10,000 of that directly to charity, which is just an electronic transfer, very easy to do from SEI, broker, your IRA account to your favorite charity, and you took 5,000 in RMD and put it in your pocket, you'd only pay tax on the 5,000. The 10 that you gave to charity would not be picked up as income. So you just reduced your income by 10,000. Not a bad deal. Okay.
Hey, Dean,
yes.
That's a quick question. So in that example, as you're pulling out that 15,000, the full 15,000 impacts your taxation of your Social Security benefits, or
no.
just only the 5,000 would impact the taxation of Social Security benefits?
That's a great question, Mahesh. The 15,000 was your RMD. If you turn over 10 of that to charity, it has no income, no tax impact on your Social Security. Okay. In fact, it may make some of your Social Security not taxable because you reduced your income. It actually helps you by reducing your AGI and reducing your income because you gave it to charity. So that helps you there. It reduces your AGI, which could, for instance, maybe allow more of your medical expense to be allowed. For those of you that have AGI around 250,000 if you're married, or half of that number, or 200,000 if you're single, excuse me, there's a tax that kicks in. It's called the Medicare surtax, 3.8% on your net investment income. By doing this QCD, the qualified charitable distribution, you may bring your AGI below those thresholds and then no longer have your investment portfolio income taxed by that 3.8%. And as a future tax benefit, if you reduce your income, your future Medicare premiums will go down as well. So there's significant benefits to doing the qualified charitable distribution. There is no downside to this. Zero.
Yeah.
Okay. And you have to be charitably inclined. That's it. What's that, Mahesh?
Yeah, you said the key words. You have to be charitably inclined. We have several clients that have actually taken advantage of this QCD, and we've talked to other clients that are just not charitably inclined. So it doesn't make sense for them to when they're not giving charity anyway. But we come across several individuals where they're over 70 and a half, they're still giving to a charity, and the most common one is their church. So they're still giving a part of their income and still tithing to the church. And that most of them have never thought about just giving directly from the IRA to the church in order to reduce the taxable income. So I know we have a few accountants on the call as well. I would highly recommend looking at the charitable deductions, especially for those clients that are 70 and a half or older, and looking at this QCD strategy, if it would make sense rather than them giving cash out of their own pocket, is having the RMDs go out from the IRA directly to the charity.
Yes, it's a great, it reduces both your AGI and your taxable income. So it's kind of a double bonus. Regular charitable contribution at best can only reduce your taxable income, but a QCD can reduce both your AGI and your taxable income. So a double benefit.
Yep.
Okay, let's get into estate planning. This is an area of immense interest in our planning group at SEI. We feel that going forward, we do have a high probability of both estate and income tax rates going up. This is a great time to be reviewing your basic planning documents. We just went through this personally. We had our wills and our durable power of attorney, living wills, all updated. One thing that COVID brought to mind was when people were in the hospital and had these directives, and you gave the power to another family member or a spouse or anyone to give direction about treatment, normally you had to be there physically and put a wet signature to authorize procedures. Well, guess what? No one other than the sick were getting into hospitals earlier this year. So how could you give those directions if you couldn't physically be there? So we have updated our documents to allow for remote communication. This is the world we live in now. This whole meeting, if we were 7 months ago and we had this meeting, I would be in Las Vegas giving this presentation. Okay, I'd be physically present there. Okay, the world has changed. Now we do it remotely, but your documents need to reflect that remote communication is possible. You could authorize through a Zoom meeting. You could sign a PDF. An email is okay. Okay, this is the world we live in. Great time to be updating beneficiaries of life insurance policies and retirement plans. Be careful what your directives say. I hope you did not pull a directive off of the internet and signed it without reading it. A lot of those directives say, do not intubate me under any circumstance. Well, guess what? If you want to get on a ventilator and your directive says, do not intubate me, well, guess what? You're not getting on a ventilator. So you better make sure what the language is. I know this is not the most pleasant thing to be looking into, but it is important for you and your family to make sure your basic documents are correct, they express your wishes, and they are up to date. Now, I do want to talk about, there's huge differences between the two candidates running for president, Joe Biden and Donald Trump. Trump basically wants to make the Tax Cut and Jobs Act that took place in 2017 permanent. As it stands today, the Tax Cut and Jobs Act will expire at the end of 2025, and that's both on an income tax and estate tax level. So the current generous exemption we have for estate and gift tax at 11.58 million, that will go away regardless of at the end of 25. if we see a Biden victory and maybe even a blue sweep, who knows? I'm not calling for that. I'm just saying, talking out the future, we could see a change well before 2025. And the exemption that they're talking about, Biden and his fellow Democrats, is a $3.5 million exemption, and potentially the elimination of the step up in basis for inherited assets, which is what we all strive for from one generation to the next to make sure we get the step up. My point here is if you have the ability, you may want to think about using this $11 million exemption or some big chunk of it now, because if you don't use it, it's very well you'll lose it. You won't get another chance to do this again. At the end of 25, we expect the exemption to go down to 6 million, though, as I mentioned, the Biden camp is looking to significantly reduce this exemption amount. We're thinking maybe around 3.5 million. So let's say you use 6 million of your exemption this year or the beginning of next year or something like that. There is no clawback, meaning that if you use an exemption amount that's higher than what the new law would be, there's no clawback. They're not going to come knock on your door. Hey, the exemption is only 3 million, you use 6 million of your exemption, you owe us tax on 3 million. That's not going to happen. That's baked into the tax regulations. Okay, but the point here is this is a very generous exemption right now for gift and estate tax. Don't expect it to stay around. Okay, it is in the crosshairs of the Democrats to change this, and they're going to change it as fast as they possibly can. Now, granted, we are in a recovery, and there might not be much of an appetite next year, but we'll see. But we certainly expect rates to go up for sure in a Democratic regime. So there are many favorable tax planning opportunities could disappear, okay? So again, married couples can transfer quite a bit of money without any tax liability at the federal level. The one thing that we've seen that has not going to change is the portability of the exemption between spouses. That has been maintained. Essentially what that means is if each spouse has, I'll just round the numbers out, $11 million exemption, I don't use it. When they file my final estate return, that my unused exemption can be ported over to my wife so that she can use it. And as I mentioned, there is no clawback. If you use your exemption and they later change the amount to a significantly lower number, it's protected, okay? And I gave the site for that. So something to consider, but there are very powerful estate planning techniques that are in the crosshairs. Now, what I'm showing you here is from Senator Sanders. Now, obviously, he's not running for president, but believe me, there are plenty in the Democratic camp that are thinking like this. So, and here are some of the provisions that they're talking about. Now, one of them I want to mention is the GRAT, the Grantor Retained Annuity Trust. Very powerful planning technique, and you could not ask for a better interest rate environment to do a GRAT. A GRAT is a way to basically, it's an estate freeze technique so that the future growth of your assets is out of your estate. And you really only need to have two things to make a GRAT work. One is you have to hurdle the Section 7520 rate, which is its lowest in history at 0.4%. I can beat that with municipal bonds. And you have to live out the GRAT term. So we've been doing a lot of GRAT modeling, and a lot of clients that are of wealth are looking at this at a very high rate. And we've been doing 5-year GRATs is the sweet spot right now because we want to lock in that Section 7520 rate. And if people are in good health, 5 years is not a very long time. You don't want to do really super long year GRATs because, again, if you don't live the GRAT term, the GRAT fails. So that's one technique that we're looking at. And the other is the Charitable Remainder Trust, or more specifically, a Charitable Remainder Unit Trust, a CRUT, as a way to harvest large gains without paying an immediate tax bill, create an immediate charitable deduction, and then pick up long-term capital gain income over, for instance, over a period of years or based on some type of life expectancy. If you're interested in those types of ideas, talk to Mahesh. But everyone of even moderate wealth should be thinking about a dynasty trust. Essentially, what we're talking about here is just an irrevocable trust to remove assets out of your name and put them in a trust for the benefit of your family. This generation, the next generation, these things can live for a very long period of time. They can pay out to the beneficiaries for education, health, first-time marriage, all kinds of things. And these trusts last forever because it provides both creditor and predator protection. Tremendous vehicle to be setting up. Okay, so just some highlights there of what we're looking at potentially. I'm not saying these changes are going to happen, but we're certainly looking at these real hard. And what steps can we take now to protect ourselves from these potential changes? And again, it's under predication that we believe in a very high probability that both income rates are going to go up, income tax rates up, and we're going to see major changes to the estate and gift law, and not in a favorable way. Now, just to end up, tax planning is a year-round exercise. It's a multi-year exercise. We're not trying to reduce tax in any one year. We're trying to reduce taxes over multiple years. Not everything I've talked about today is going to make sense for you, but you should work through the process to see if it does or does not. Okay. Now is a great time to look at your estate plan, make sure your documents are up to date, and take into consideration the new world that we live in. And we are now in the fourth quarter, and it's a great time to be looking at year-end tax planning strategies, whether it be Roth conversions, accelerating charitable contributions into this year, funding a donor advised fund, planning for RMDs in 2021. Okay, this tax is something we can control to some extent. Okay, let's exercise some control where it's going to make a difference in our lives. Okay. Investments are a matter of belief. You know, we invest living going forward. Returns can be erratic at times, but what can we do? And we can control that tax bill, and that's, I think, where we should be spending our time. And then I'll have to have my legal disclosure here for a little bit. With that, I'll take any final questions or comments you may have.
Thank you, Dean. I appreciate it. Again, if you have any questions, go ahead and pop them in the question box. Dean, I would be happy to address that. And also since year end is coming up, and I do see we have some business owners as well as accountants on the call here. As you may or may not have worked with us in the past, but one of the strategies for business owners, if you own a small business, either a sole proprietor or as an entity, LLC, S corp, whatever that may be, but year end is coming up, and some powerful tax planning techniques exist also on using retirement plans. So for small business owners, 401ks, profit sharing, SEP IRAs, if you are in that boat, definitely feel free to reach out to us. I would be happy to run some projections and work with your accountant, because what those strategies can create is also additional deductions on your what they call QBI, the Qualified Business Income Deduction. So it may enhance some of those deductions that you can take on the QBI side as well. So I just want to throw that piece out as well, Dean. But I don't see any questions so far. So, and let me look at the chat box here. I don't see any questions, Dean. Any last words to wrap up?
Just vote. Very important to vote this year. And that's my final comment.
Yes.
I hope the Eagles win tonight.
Thanks, Dean, and wish best of luck to the Eagles. Again, thank you, Dean, for making yourself available for this very important topic. Thank you, everyone, for joining us. The recording for this will be available in the next few weeks as soon as compliance reviews it and makes it available. Looks like we had a comment. Debbie, thank you. Debbie said thank you. Thank you, Dean. So really appreciate everyone being on the call. Have a great rest of Thursday, and we will see you at our next webinar. Take care.
Bye, everyone.